Bitcoin just crashed 8% in one day. It's $84,000, down from $91,000. And crypto stocks are bleeding even harder. Strategy down 40%, Coinbase down 20%, Circle down 38%. But here's what nobody is telling you. This crash has a name, and it came from Japan. Welcome to Wall Street Lens. Let me explain what actually happened. Japan is about to raise interest rates. Why does that matter for Bitcoin? Because of something called the yen carry trade. Here is how it works. Investors borrow Japanese yen at near 0% interest. They convert it to dollars. Then they buy risky assets like US stocks and Bitcoin. Free money, easy profit. Until Japan raises rates. When Japan raises rates, the yen gets stronger. Suddenly, those borrowed yen cost more to pay back. So investors panic. They sell their Bitcoin. They sell their stocks. They rush to cover their loans. This is called an unwinding. And we have seen this movie before. August 2024. The same thing happened. Bitcoin crashed from 66,000 to 54,000. 18% drop in just a few days. Markets panicked. Headlines screamed disaster. But what happened next? Bitcoin recovered, then hit new all-time highs. History does not repeat, but it often rhymes. Now let us look at the bigger picture. Bitcoin ETFs just had their second worst month ever. $3.5 billion in outflows. The token is down over 30% from its October high above 126,000. That is a massive correction. Sentiment is weak. Bernstein analysts say they are still looking for clear signs of a bottom. 10x Research says a sustained rally is unlikely before year-end. But here is where it gets interesting. The Federal Reserve is expected to cut interest rates in December. Lower rates mean cheaper borrowing. Cheaper borrowing means more money flowing into risk assets. Bitcoin is a risk asset. So while Japan is creating short-term pain, the Fed might be setting up long-term gain. Now, let us talk about Strategy. Formerly known as MicroStrategy, the largest corporate holder of Bitcoin. They own 650,000 Bitcoin. Their stock has crashed 40% in the past month. It just hit a 52-week low. Why? Investors are worried. Strategy has $8.2 billion in convertible debt. If Bitcoin crashes hard enough, they might have to sell Bitcoin to pay dividends and interest. That fear is crushing the stock. But is the fear justified? Let us do the math. According to benchmark analyst Mark Palmer, Strategy would only be unable to cover its debt if Bitcoin fell below $12,700. That is an 86% drop from current levels. Has Bitcoin crashed 80% before? Yes, multiple times in its 17-year history. But here is the difference. Back then, Bitcoin was driven by retail speculation. Today, institutional money is in the game. BlackRock owns Bitcoin ETFs. Fidelity owns Bitcoin ETFs. Nation-states are accumulating. The buyer base has completely changed. For Bitcoin to crash 86% now, multiple macro shocks would have to happen simultaneously. Possible? Yes. Probable? In my analysis, no. Strategy also made a smart move today. They announced a $1.44 billion cash reserve, specifically to cover dividend and interest payments. This tells me management sees the fear, and they are addressing it directly. They also bought 130 more Bitcoin last week. They are not slowing down. So what is my take on all of this? Here is my honest analysis. Short term, expect more volatility. The Japan situation is not over. Sentiment is weak. Year-end rally looks unlikely. Medium term, watch the Fed closely. If they cut rates in December, money will flow back into risk assets. Bitcoin could stabilize and recover. Long term, 2026 could be very different. Institutional adoption is growing. Bitcoin supply is fixed. Demand is increasing. The math favors holders. But let me be clear, this is not financial advice. Bitcoin is volatile. It can drop another 20% tomorrow, or it can recover next week. Nobody knows for certain. What I do know is this: panic selling at the bottom is how most investors lose money. And buying when others are fearful is how wealth is built. That is my analysis on the Bitcoin crash. Japan triggered it. Weak sentiment is fueling it. But the macro setup for 2026 still looks promising. What do you think? Is this the bottom, or is more pain coming? Drop your thoughts in the comments. If you found this helpful, hit subscribe and turn on notifications. Wall Street Lens. See the market clearly. See you in the next one.